As a multifamily investor, sometimes I invest as a limited partner, but most times I invest as an active partner. But the periods I've invested as a limited partner, I've been able to seriously scrutinize the projections from the sponsor, whoever has the deal. And the reason why I get to do that is to minimize the risk. Every investment has its own risk, but in order for me to minimize it and see that everything is solid tight, there are some things I do. And so I have 6 tips for you as a limited partners. What are the things you should look out for before dropping your $50,000, $100,000, $200,000, whatever the amount is to you? You want to try as much as possible. After verifying the sponsors, there's some questions you should ask them about the underwriting. So what are some of the questions I should be asking the sponsor or the person behind the underwriting? Number 1 is the rent projection. And if you've seen or heard some of my podcasts, you understand why I'm asking these questions, because one of the multifamily fundamentals is market analysis. You want to understand where the market is at, what their rent is currently at, and what your property is. So in other words, I'm asking the sponsor, how did you come about your rent projections? Because if they get that wrong, the entire business plan is faulty. The returns that they promised you, you will not even get it. Not you might, you will not get it. Because 1, the rent projections are wrong. And why is that important? Because the rent projection is more like the value add a result. So maybe they are saying that they have to renovate the units, they have to do this, but the purpose of doing all that is maybe to bump rent or to increase the value of that property by increasing the rent. If that is the case, then you need to ask questions about what is the projection behind bumping the rent. Is the market saying that? So if they're saying that they're going to increase the rent by an additional $500, you need to ask questions. Are others in the market doing that? Where is their rent at this point? And why do you think you can get there at this point? These things need to be asked. I've seen people's underwriting and I get to question, how did they come about it? Because the data that I've seen does not prove this. I'm in the Dallas market, so any deal that they bring to me in Dallas, I understand it and all that. So you should do that in any market you want to invest in. You should be asking, what are the rent projections? The next question you should be asking is the occupancy rate. You want to understand the occupancy in the entire market. And the reason why that is, multifamily works with the market, means that it works with demand and supply. Yes, this current property, maybe because the owner is selling, the property is like 100%. But you need to also ask the question, what are other properties similar, maybe similar management, similar everything? What are they operating at? What is the general occupancy in that market? You want to ensure that they are using the market occupancy to do that. And if it's different, what is the idea behind that? They might say, we've gone to other properties and they have property management issues, or the properties are not well renovated. They are still in their vintage state and all that. So that is why they are not getting the type of tenant that you should assume that you get. But ours will be different, because we believe that if we have the right property management, if we're able to increase the value of the property by making it up to standard, we'll be able to get this set of people and our occupancy rate to reduce. You need to understand what is the story behind it, but at the same time understand where the market, when I mean market, the comparables around it, where they are currently at. That will help you to realize their occupancy projection is achievable. But the third question as an LP limited partner that you should be asking the sponsor is, what is your exit cap rate? And the reason why you want to know that is because the exit cap rate determines the value of the entire project. Right now the property is valued at 13, and when we're exiting it to be valued at 20. You want to understand how they came about the exit, because the exit cap rate determines the value of the property. You want to know how aggressive they were or how conservative they were. So you want to know the assumptions around that, because it's very, very important that you understand, because we've seen people, maybe their entry cap rate is, let's say 6%, and they will say they are going to exit at 5.5%. That is very, very super aggressive. So in blue oceans, what we always tend to do is we always go for the most conservative exit cap rate. And depending on the market like Dallas, or if you're looking at the market condition, we might increase our cap rate by 0.1 or 0.15 or 0.2, depending on the market. So for our PA market, we do it at 0.15 or 0.20. It's just a conservative approach approach. What that means is that we are trying to take an approach that means that the property is going to lose value as it's going, and this is going to be the value at exit. But we've seen people doing it in the reverse. Rather than them assuming that a property will lose value, they are saying that the property will gain value. The probability that yes, at exit the property will gain value is relatively high, but you don't also want to underwrite towards that, because what if anything happens? We saw that happening when the Fed increased the interest rates recently and the cap rate started increasing, that is, properties started reducing value. So if sponsors have been written to be very aggressive, then they would have been in trouble at this time. So you want to understand everything behind that. The fourth is the operating expenses. Now, this is very, very crucial. You want to understand the projections and the assumptions around it. You want to know how aggressive or conservative they are. You want to compare with the last, they call it T12, that is the actual that happened, what really happened in the last 12 months of when the current owner was operating this property. You want to see that, and if possible, another 12 months, that is 24 months, you want to see the trend of the operating expenses. But in Blue Ocean, how we intend or how we do this is we carry it out with a local property manager. We already have a relationship with a local property manager that understands that location, that understands how other properties, similar properties, are operating. So we get to ask them for their own projections, and we also get to check what the current seller is doing. And we check out the loopholes and we say, okay, based on this from the property manager and based on the trend of this property, this is what the expenses should look at in year 1, in year 2, and in year 3. How they came about their expense projections. One of the most important questions you should be asking the sponsor is the financing terms. This is very, very important, because most limited partners, what I find is that they don't get to ask that question. But recently, because of what is happening, we are seeing foreclosures or property just selling off at discounted rates. We are seeing limited partners asking questions. Is this fixed? Is it a floating rate and all that? Just because of what happened. But before now, we've seen trends like limited partners not asking those questions. But as a limited partner that is intending to drop or give 50% or invest 50,000, 100,000, 200, whatever the amount might be, this is a very crucial question for you to ask. What is the loan terms? What is the LTV? Are you over leveraged? What is the interest rate? How long are you holding it for? What year is the balloon? These are very important questions that you need to ask. And the final thing is you need to ask them, did they get this from an actual lender or they are doing it based on general market? The reason why you need to know if they got this from a lender is because to a large extent that is very, very accurate. You know that, okay, their estimation is correct. But if they got it from the general market, those things are vulnerable. They can change at any point in time. So these are the questions you want to ask before putting down your $50,000 or $100,000. The last one is capital expenses. Some of us might look at it that this might not just be important. I have the rent under control. You've told me what the financing is. You want to know, especially when it's a value add and they have to do renovations, you want to understand how much or what is the CapEx estimation that they are doing. Did they just come up with numbers, or they involve third-party vendors or contractors, general contractors, and they got the actual quote? Because there's something you need to understand. Every amount in an underwriting affects the entire returns. So you want to know if at the beginning they got the third-party vendors to give them the quote, and maybe down the line, maybe they didn't get one, and maybe down the line they decided to work with a third-party vendor and they saw that instead of $10,000, the expense is actually $100,000. The difference between what they communicated with you, that is $10,000 versus $100,000, is $90,000, and that can significantly have an effect in your returns or whatever returns that they've communicated to you. So my dear investors, as an LP investor, which I'm currently doing, and as well as being an active investor, these are the questions I always ask the sponsors. I need to see the underwriting. I need to know what your rent projection is, your expense ratio is, what is the market, your financing. These various questions I've just listed are very, very important before I can take my decisions. In Blue Ocean, we do all these things I just mentioned. We take our time to do our underwriting and we do our projections, not not a one-off projections. We constantly, throughout the whole process, and even when we close, we constantly monitor the market to see exactly what the market is saying and to see the trend. Even when we are under contract, we also want to see the trend of what is currently going on. It's possible that the seller or whoever you're buying the property from is not currently operating that property as it should because you're under contract. So we continuously check the trend, and we always do that, and we communicate to our investors. This is what you should expect. And so far, doing all our investments, we've been able to surpass all the projections we've given to our investors. I hope this was a very good tip for you. As a limited partners, these are questions you should keep asking. I hope today you start asking every investment you are going into these questions. If you're looking at starting your multifamily journey, or you want to take your investment to the next level by investing with the right sponsor, or a sponsor that has done their due diligence or done the proper projections for their underwriting, you can book a call with us today and start on your multifamily journey, where we critically take a look at all our projections before communicating it to our investors. I look forward to hearing.